This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, we're getting great feedback on the new Trade of the Week segment. What's on deck this week?
Listeners, you're going to find the download link for the post-game Trade of the Week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Matt's picture saying looking for the downloads. Eric, let's go a little deeper into the AI bubble theme we just heard from Matt Berry. Now, Matt raised some serious concerns about the sustainability of this AI boom. But what I've learned in almost 30 years of trading is that bubbles always go farther and last longer than any rational person expects. Shorting the bubble before it pops is a widowmaker trade. You can be absolutely right about the end game and still go broke along the way there. The time to press the short is after the air's already started coming out of the bubble. So the way I think about it is this. As Soros famously said, when he sees a bubble, he buys it. In the short term, the performance is chasing where the money is flowing. But because you know how it ends, you have to play it in a convex way with defined risk. Instead of just sitting Delta 1 long and fully exposed on the left tail. That's the lesson from Stanley Druckenmiller, one of the smartest traders of our time, who openly tells the story of buying billions of dollars of tech stocks near the top of the dot-com bubble, only to lose $3 billion in 6 weeks when the music stopped. So how do you apply that lesson today? A good example is NVIDIA. If you want to participate in the AI run, but with defined risk, instead of buying the stock outright, you could structure a bull call spread. For example, out to December 2026, you could buy the 200 call for around $10 and sell the $220 call for about $4.40. That's a net debit of $5.60. What does this give you? A maximum upside of $20 between the strikes, less the $5.60 you paid, so about $14.40 potential reward against $5.60 of defined risk. In other words, almost a 3-to-1 upside with no tail risk. That's exactly how you chase a bubble in a smart way. Convex exposure, defined downside, and plenty of participation if the mania continues running. So Eric, that's exactly how you chase a bubble the smart way. Convex exposure, defined downside, and plenty of participation if the mania keeps running. If anyone wants to look at this deeper, the breakdown of the trade is on page 2 of this week's chart deck.
That explanation worked for the pros, and of course our retail audience can get the full briefing by attending Patrick's Monday webinar, which always dissects the trade of the week in detail. MacroVoices listeners can get a free trial at bigpicturetrading.com. Patrick, let's start with equities as per normal. What are the charts telling you?
So Eric, at the time of recording here, the S&P 500 is trading at 67.53. The S&P futures closing exactly at 6,800. We continue to close at fresh new highs on this S&P as it relentlessly continues to climb. So there is absolutely nothing bearish to say technically on the trend. Old dips keep getting bought, higher highs and higher lows. Everything is working in the favor of the bulls. But Eric, when we look at this from a quantitative perspective, this is not only the longest rally in duration, but also the largest in magnitude that we've had without a 5% correction this decade. That's 100th percentile. At some point, we are going to just get a correction. It's just very natural that the market does that, and it's going to inevitably come. What are some of the things that are concerning from that perspective? Well, number one, we are continuing to see the breadth of the market deteriorating. We have only only 55% of stocks trading above their 50-day moving averages in this environment. That's come off of a high of near 75-80% just a few months ago. Yet the market here continues to make new highs. It continues to show that the market is relying more and more on a fewer and fewer number of stocks to keep this going. Another example of that is looking at the financials, the quintessential beta 1 asset. They have put in their highs back in August, and we have not been able to see the XLF financial ETF make a higher high and hold it since then. And so we've continued to see that this market is participating pretty much on this AI boom, and the breadth of the market is not contributing. This in itself is showing that there is a weakness under the hood, and inevitably something will be a catalyst that will spur on at least a solid 300 S&P point correction in the 5% variety. We'll see what the trigger for that ultimately will come at.
Patrick, let's hit the dollar index. Plenty to talk about there.
Well, Eric, let's talk about that dollar, because the dollar has broken to a higher high. And we have now seen that trade range that was established throughout July, August, and September starting to be broken to the upside. Obviously, we had a brief little rip higher in late July that still hasn't been able to be beaten. But overall, we've seen the price action of dollar strengthening. We're now 4 or 5 days above its 50-day moving average. But it's not just the dollar index chart that's interesting. It's about the fact that the cross currencies are all breaking. We see a euro break to a little bit of a lower low, now consolidating below its 50-day. The pound sterling having had a failed rally here last week that couldn't beat its 50-day moving average and roll over. We had those surprise election results in Japan that sent the yen lower, with the US dollar ripping to now almost 6-month highs against the yen. We have the US dollar against the CAD breaking out to multi-month highs. And so we're seeing that under the hood, we have a lot of these currencies where the US dollar is already strengthening. To me, this is very interesting because arguably so many of the asset classes from an intermarket perspective that have worked so well this year had the tailwind of a weak dollar. If the US dollar here begins some counter trend trade, maybe it's just a retracement, maybe it's not a new US dollar bull market, but some sort of a retracement that lasts several months and mean reverts a part of that loss. The question is that going to be the catalyst that spurs profit taking in so many of these assets that have worked so well because of the US dollar weakness? Nonetheless, watching here whether this US dollar breakout is for real.
West Texas Intermediate crude oil broke down to retest its May lows last week, but our good friend Dr. Anas Al-Haji has a research note out saying the bearish narrative probably isn't right. So what comes next in the charts, Patrick?
Yeah, Eric. Well, looking at crude oil, technically, the price action is quite distributive. Lower highs, lower lows. Now, while we have bounced this week, we haven't been able to bounce back above the 50-day moving average, nor above its basic 50% retracement of the prior sell-off. So you still have to assume at this moment that this price action is distributive. But overall, we have seen a fair value zone established throughout the summer in this kind of low 60s area, and we haven't seen a technical legitimate breakdown out of it. And so in theory, this consolidation could see the oil trade back to the top end of the range and just stay dominant in this new fair value zone. In the end, there is no technical evidence that there's an imminent new bull breakout. That false start a few weeks ago kind of ended that very quickly. But I'm still looking at this very much from a neutral perspective.
And Patrick, needless to say, we've got to hit the gold chart this week.
Yeah, Eric, we do have to talk about gold. Like, what a rip this thing has had. We've now cleared the 4,000 mark and are completing the measured move by just simply comparing the length of the first part of the rally that happened in the first quarter of the year to the length of this bull impulse. So now we're in a situation where gold is pretty much starting to exhaust itself. And what's interesting is that silver finishing a measured move, platinum and palladium breaking out in this extraordinary way. We just have this amazing bull run in the entire precious metals market. So to me, this is balancing the long-term bullish perspective of precious metals, because I think that this has legs to to continue in the years to come, doing incredibly well, and balancing that with short-term tactical strategies in terms of whether this is the time to accumulate more, or whether you need to wait for a pullback in order to reposition yourself on any precious metals positioning. As from my perspective, I think at this stage, there is very little asymmetry in starting any new buying here on gold. At some stage here, like we talked about last week, there's a potential at any point for a $200, even $300 pullback that would just be the new buying opportunity. I'm not in any way bearish, but I think there's lots of opportunity now to wait for pullbacks for new tactical entries.
Patrick, I can't believe it, but because I've been traveling all week, I'm actually out of touch with the uranium market as well. What's going on in the charts?
Well, Eric, let's talk about uranium. As I've said in previous episodes, we had a bear market that ended back in March and April from looking at it from the commodity price. And we've seen generally positive price action over the last 6 months, higher highs, higher lows, above all its moving averages. Now, this week, we finally got a breather, a pullback, and it's coming right to a 50% retracement, coming right back to the levels where the highs were back in June and July. This is a very interesting moment to see whether the buy on dip traders show up right in this sweet spot, because that is a typical area where you would see, if it was bullish, the dips starting to be bought here.
Wow, Patrick, we're talking about whether or not copper was going to find some legs in its rally. Big breakout last Friday. Seems like the market's got the idea. What comes next?
Well, Eric, on that copper chart, we definitely are seeing short-term bullish price action. Every dip is being bought. Higher highs, getting above key high volume consolidation levels that were established earlier in the year. It's very reasonable to assume that we could be testing some of the highs that were established in 2024 and 25 up near the 5.25 to 550 area just above.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Finally, I wanted to just touch on that 10-year Treasury yield. And we continue to see is that the yields continue to make lower lows and lower highs, continue to reject a basic 50-day moving average. So you still have a primary downtrend in yields and a primary bull phase in bonds. We're going to continue to see whether that trend continues. But at this stage, it's very plausible to have downside targets near 360 to 380 on the yields.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.